Hello, everybody. This is the Zoom Round 1 review. Happy New Year to everyone, and it's a very, very cold January day. So let's review the results of the simulation, Round 1. Now, 40 million is a good level of profits. A number of companies reached 40 million or above. Only one company had only 8 million in profit. So this company, no names of who's running this, but this is a company that strikes me that they didn't watch my YouTube preparing for the Zoom simulation videos or the student manual. So I will try and help this company a little bit, give them some ideas to improve their score. Looks like the company that did the best right here is JR Auto, had the highest net income of almost $64 million. So congratulations, that's terrific. So let's move down to points. Now, points are measured off of the overview page. Now, the overview page looks at last year's performance in about 15 or so operational and financial metrics compared to this year's performance. So if you do better than the previous, now the previous management team who ran the company what we call year zero, which is the first year of the company, just like when you're born in year zero and it takes 12 months before you're a year old. You started running this company after 1 year. So the previous management didn't do such a great job. So everybody here mostly did very well on their points. If you look at the 1,000-point level, a number of companies came close to or exceeded 1,000 points. Now, that's important because I think you need something like 2,600 points to get an A on this project. So those teams were almost half the way there. Other teams, some teams didn't perform as well, but I feel as long as you get, close to 500 points or more in round one, you're doing very well. So I was happy to see so many teams did very, very well in this first round. Okay, so if we look at stock price, there's one company, JR Auto, who had the highest stock price. Kind of makes sense. They had the highest net income. And remember, the strategy of companies is really to maximize shareholders' wealth. So whatever strategies companies are trying to employ, their short-term and or long-term goals, hopefully long-term, is to maximize shareholders' wealth. So the company needs to do what it does to make sure that it makes money. Now, don't be confused by the brainwashing you've experienced for most of your life, where companies put on these commercials and all of their media that they give you the best product possible for you for the amount of money they charge you. So we're going to give you the highest quality at the lowest cost. That's bullshit. What companies are doing is they're giving you the highest price possible that you'll pay for a product and the lowest quality or cost or features they can put into it that you'll accept. So companies are trying to make products that are more profitable by raising the price they sell them at, if they can get away with it. That's not always the case for some products that are more like commodities, which you'll learn in our strategy books, and or try to reduce the cost of the features or the amount of features they're providing you. Some consumers may not even want to make more of a profit. If you want a clear example of this, look at all of the supermarket items. If you're someone who's 30 years or older, you should notice that most everything is smaller. Peanut butter, yogurt, ice creams. Haagen-Dazs is significantly small. That's why Ben and Jerry's still a pint to let you know they haven't shrunk their size yet. But a lot of these food companies have shrunk their size with packaging to make it look like it's the same size, dimpling the bottom, contouring the sides, giving you 4 to 6 ounces of less peanut butter, or 5 to 10 feet less feet of paper towels, or 6 to 7 less garbage bags, or whatever. Cereal boxes are a lot thinner on the side, but when you look at them, they look just as big as always, but the actual thickness of them is much thinner because they're putting less cereal in, but charging you the same price. Package of Oreos are half the size I remember when I was a kid. Same thing with Chips Ahoy, but the price is still inflation adjusted about the same. So companies, they want you to think that they're giving you the highest quality possible at the lowest cost, and they're not even making any money. But that's not true. They're doing the opposite of that. So if you try to make your car with the most amount of features possible and the lowest price possible, you're not going to have very much profits. And that's a problem. So you have to forget about your consumer side as a consumer. And now you're behind the curtain as running a company, and you have to understand that companies are maximizing shareholders' wealth, and their goal is to increase stock price. So majority of the companies increase stock price pretty nicely. There are two companies, JD Auto and Edison, that had some struggling and issues. So we'll look at those companies later, see if we can help them. Sales per team, and you can see here the sales were, everybody increased their sales except for Edison. So everybody did increase their sales. Some people increased their sales to 260 million, while others only increased their sales to 184 million, and everybody started at 121 million. So most companies did a good job. And how do you know what your sales are going to be? Well, you don't. It's a forecast. It's an estimate. And that's why you use the student user guide. It gives you the growth rates and sort of what the projected sales would be if every company was equal, going to have an equal share of the sales. So the student user guide gives you a really good idea of how to forecast. And then if you feel your cars are much better than your competition, you could forecast more than what's suggested or less, depending on how you're making your vehicles. Okay, so earnings per share per team, and this is just the net income divided by outstanding shares. We could see that JR Auto is number one, followed by Luxury Motors, and then 512 Automobiles. And then, of course, at the bottom, we have the two companies that make sense, GD Motors and Edison, who didn't have the highest profits or stock price. It makes sense that they'll probably have the lowest earnings per share because stock price is driven mostly by earnings per share. So if you're going to buy a stock and you want a company that does a good job at maximizing shareholders' wealth, which means they're providing and producing high earnings per share compared to the competitors. Okay, this is just market share, so we're just going to market share by sales in dollars. Okay, so we're going to move on. So I'm going to try and help these two companies that had some issues, and let's see if I could find them. Okay, so here's one of the companies, and you can see that they did increase their sales, but their profits were much lower. And so so there's sales versus profits. Sales increased, profits declined. That's not what investors want. Just if you own a company, you wouldn't like that either. Okay. The stock price did increase, not tremendously, but mostly because of the increase in sales, because it does have value. Earnings per share went down. The most important chart, I think, to look at is this one right here. This is called the market potential versus actual sales. And you could find this when you go into the simulation. There'll be a page called charts, and you look on individual charts. The very bottom individual charts will give you market potential versus actual sales. The blue area is how much you could have sold based on how well you built your car. So this company really did a pretty decent job, really good job in making their car. However, they only forecasted and sold 1,000 vehicles, where they could have sold 3,000. So it looks like their forecasting strategy was 1,000 vehicles for each car, which is actually, I think, low. The lowest of everyone in the simulation. But they could have sold 3,000 sedans, 2,186 trucks, and 2,033 luxury vehicles. So they completely missed their mark on their forecasting, and that's what held this company back. It looks like they built decent cars that the market responded to and that they wanted. This company just didn't make enough automobiles to meet the demand. So that was really the one real problem. So that company, I'm sure, when Edison does the next round, they will correct that. So let's look at the other company, JD Motors. Okay, so again, they increased their sales and their profits, and their sales and profits, and their stock price went up a decent amount, and their earnings per share went up. Let's see. Okay, so again, this is a similar story. It's a forecasting issue. So they under forecasted what they could have sold. So here they could have sold 3,000 vehicles. They only forecasted 2,100, 1,800, and 1,600. So they probably made better. They probably actually made better cars than a lot of companies. They just didn't make enough production to meet those cars, and that is a real issue. So some companies may see that this yellow dot is the very top of the blue bar, which means they've met all their market demand. But that could lead to another problem. You may have unsold vehicles, which will show up in your inventory on your production page. But don't worry, you can resell them. They'll retool them and resell them next year. So you don't have to build them again, and they'll help you be more profitable the following year if you had excess inventory. Now, if you did have excess inventory, that will, on the production page, you need to factor that in. Okay, so on the production page, this is the production page. If you had excess inventory, it would show here in current inventory. This company has zero current inventory, meaning they sold everything. But your forecast, whatever your sales forecast is, less your current inventory would be your production estimate that you should enter in. Now, keep in mind also that operational investments are very important, and that you should, whatever excess profits you have, you should invest back in your operational investments, because that lowers the cost of building your car the next round. It takes a year for it to be into effect. And that's very important, because you'll never keep up and increase your profit margins from year over year unless you invest in operational investments. And that's critical, because companies expect that, companies, the management of companies expect that the companies can become more profitable. And the shareholders definitely expect that every year companies are having higher sales and more profits. Now, if you look at the auto industry, a car from 30 years ago compared to a car today has a much more componentry, many more safety feature, airbag, anti-lock brakes, rear reverse cameras, so much more you get in today's car, so much more computerization, sophistication, so much more quality. But they're doing it for a lower cost. How is that? Well, they invested in software, in robotics, in equipment, in new technologies to help manufacture a better car for a lower price. So if you don't invest in your operational investments, you're going to fall behind in the simulation, because whatever your profit margins were, and you can check this if you go to industry page, and this is something you could see everyone's car from last round, how they made the car, what their results were, just like in the real world. If the company's public, you can see exactly all this information of their financials and how they built their cars are all free to view. So you could look at your competitors. If you feel you didn't do well, look at who did the best in the simulation and see what they're doing, how many cars are they forecasting, and what was the design of their vehicles. It's last year's design, so they're going to probably improve again next year, but at least you have an idea of a comparison of who the leader of the market is, how they're doing. So, this is a company with very good profit margins, 43, 55, 45, and 54 is very high, because we started at 40%. So now the gross profit margins, most companies, you want to keep increasing your gross profit margins, because on your overview points, everything a lot of the items are tied to profits. So if you want to increase your profits, you have to get your profit margin up, which means you have to raise prices on the vehicles and reduce costs. So you could reduce costs by lowering the amount of features you want each vehicle to have, but that will also lower the market demand. So by making the operational investments, there's a way to lower the costs of your car, but not have to sacrifice the features to lower the cost of your car. So so this is a good area to look at to see where your profit margins left off in each vehicle, and you want to make sure that you can improve upon them next round, and that will help you tremendously with your points. So here's a company with over 1,000 points, and they have very decent profit margins. Now the trick is, you're expected to keep this momentum going. So next round, these profit margins need to go up again, and your sales need to go up again, and that's what investors like, companies that can do that, like Google, like Under Armour. These are examples of companies that every year they have higher profit margins, they have higher sales, higher net profits, and their stock explodes because of it. And that's creating wealth, and that's what, as a management company, the strategy you're putting together is to create wealth. So here's the overview page. So your net profits, if you don't increase your net profits, your operating and gross profits are going to be hard to increase as well. And then also your total asset turnover, your equity multiplier, return on assets, earnings per share, return on equity, all of those, will most likely be lower as well, making it hard to make a lot of points. Now, market capitalization is the increased value of the company through its stock price. It's really stock price times outstanding shares. So that will grow as you grow the price of the company or buy back stock. Now, this sales versus forecast area, last year, year zero, they hit a 65% mark, which is terrible. So this year, if you hit if you sell all the cars or close to the amount of cars that you forecasted, you probably earned a decent amount of points for increasing your the accuracy of your forecast. Now, if you have a perfect forecast and next year you have another perfect forecast, you won't see any points. So the trick here is that you may not earn a lot of points in this area, but you don't want to lose a lot of points. So you want to keep your forecast on target as much as possible. And of course, if you have, this is important too, operational investments, you get points for doubling your operational investments. So if you go from, this leaving off at 8 million, next round, if you do 16 million, you'll get another 100 points that way. And the cash surplus or deficit is just 100 points either way. So that's why I always suggested in all the videos I made before, keep a balance of 20 million or so in case every car you forecasted is going to show up in your pro forma. But if you don't sell every car you forecasted, your pro forma cash surplus will be less or even turn into a deficit if you have leftover inventory that you didn't sell. That surplus you thought you had is now a deficit because you didn't sell all the cars you promised to sell and you didn't reap all the profits from those cars. So you don't want deficits because you lose 100 points very easy on that. Okay, so now it's time for round 2. So you look to Blackboard for the due date of round 2. I'm not exactly sure when it is right now. However, it's just like in the practice rounds. Once you log in, you could look at the charts and the industry page and sort of collect your data and think about where your strategy went right and do more of that, or where it went wrong and correct that. And then you go back and now you have to redesign the car from scratch for next year's model. And keeping in mind that now the consumer expectations are higher. Every year consumers expect more. But the price the top price that you could sell the vehicle at, that's also higher, but usually not as much to cover all the expectations of increased features. That's why those cost reductions are so critical. So that's my 17-minute video sort of wrapping up how the industry of our company, our class, did for round 1 to give you an idea of how to move forward and what to change. So my advice moving forward would be review the industry tab to see what all your competitors have done, how well they did, how they designed their cars. Review your individual chart to see how well your forecast met the demand for your vehicle, and then start planning and entering in next year's data in the sales, marketing, production, and finance tab to plan out next year's strategy. And remember that the surest way I know in this simulation to increase your points round after round so you can get an A in this assignment is to keep increasing your profit margins. So if you're building your car and you're building your car and you say, oh, I want, let me try to put the best of everything in the top level. You can even exceed the top level by a certain amount. And you'll see here, I'll put the top, I'll put the lowest price possible. So here I made the best. I met or exceeded all my customers' expectations and made a very low sale price. Now I have a negative profit margin. Then you're going to have to go back and sort of make some sacrifices. And here, horsepower is not super important. Neither are luxury features. So I will, reduce those. And now I have a better profit margin. But it has to be better than last round. So that's why you need to review your results to make sure you can do that. Okay, so that's my quick 20-minute video recapping round 1. Remember that tonight, on January 8th, tonight, you have a case study due. And please make sure that you review all the assignments that are due, including the next round of the simulation, so you don't miss anything. Okay, great. Thanks, and have a great night.